Today, we're going to break down a very specific and, frankly, a pretty extreme trading strategy. It's what you might call an all-in swing. This isn't your typical advice about diversification. Instead, we're going to walk through a very methodical process, one that's designed to capture major returns by concentrating everything into a single high-conviction trade.
So why are we talking about this? Well, it starts with this quote from a trader named Kevin Zhu. He claims he turned $35,000 into $8 million in just 21 months by going all in on one stock at a time. Now, that is a massive claim. So our goal here is to really understand the process, the mechanics behind a strategy that could even make something like that possible. So let's be really clear about what this is and what it isn't. This kind of swing trading sits in a very unique spot. It's not long-term investing where you buy and hold for years, and it's definitely not day trading, getting in and out of stocks in minutes. The entire idea is to find one stock you believe in, commit to it completely, and then hold that position for a medium amount of time. We're talking days, weeks, or even a few months, all to capture one big, meaningful move in the price. All right, so where does a trade like this even begin? Well, the whole process starts with finding the right opportunity. This is not about randomly picking stocks or chasing tips. It's a systematic scan of the market, looking for two very specific signals that, when you see them together, suggest a really high potential setup might be forming. And the absolute starting point, the first and most important filter, is always volume. Before you even think about the company or the news, you're looking for unusual trading volume. Why? Because volume is a direct measurement of market attention. It tells you where the interest is. A sudden explosion in volume is a sign that big money, big attention is flowing into a stock, and that is the first ingredient you need for any major move. And here's a great way to see this in practice. Let's look at two examples. On the left, we've got a chart for CLOV. See that huge sudden spike in volume right in the middle of the day? That's a clear signal that new, serious interest is showing up. But on the right, you have CSR, which tells a totally different story. The company had positive news, but look at the volume. It was actually fading away. This tells you the market just didn't care. And that's the key takeaway here. Market attention, what you see in the volume, is often a much more powerful driver of price than the news itself. Okay, so that unusual volume gets a stock on your radar, but that's only part one. The second thing you absolutely need is a catalyst. A catalyst is just a compelling story, right? It's an upcoming event that gives the market a really good reason to believe the price is going to go up. This narrative, this story, is what can sustain that buying interest and fuel a rally that lasts for more than just a single day. And these catalysts can be all sorts of things. It could be the buzz that a stock is about to be included in a major ETF, or maybe it's a biotech company waiting for a huge FDA approval. It could be a highly anticipated earnings report, a big keynote speech at a conference, or a major new product launch. In every single case, the event creates a story about the future that attracts buyers and keeps them interested. So once you've found a stock with high volume and that compelling catalyst, the next piece of the puzzle is timing your entry. And this process doesn't rely on a bunch of complicated indicators. Actually, it uses a surprisingly simple and very clear technical signal. The entry point isn't determined by some secret complex formula. Instead, it comes down to one of the most basic ideas in technical analysis, a long-term support line. This is simply a price level where, historically, the stock has stopped falling and found enough buyers to bounce higher. Now, the psychology behind this is really what's important. Imagine a stock has been in a long decline. When it finally drops down to a major, well-established support level, it often signals a point of exhaustion. The idea is that the sellers, the people who've been panicking, have finally run out of steam. They've all sold. And that exhaustion of sellers creates a much cleaner opportunity for new buyers to step in and potentially kick off a reversal. So, you've found the opportunity, you've timed your entry, you're in the trade, but getting in is just the beginning. The real discipline comes in managing the position from day to day, and this part isn't guided by gut feelings or emotion. It's all about a very clear and simple process. Once you're in a position, the management process boils down to asking yourself one simple question every single day. Is my thesis alive or dead? That's it. You're just asking if the original reasons you entered the trade are still true. This one question is designed to cut through all the noise, all the little daily price swings, and force you to focus only on what really matters. And the decision you make is pretty black and white. If the thesis is still alive, meaning the volume is still strong and the catalyst is still on the horizon, you hold the position.
You hold it even if the price dips for a day or two. But if the thesis dies, if that volume disappears or the catalyst turns out to be a dud, you sell. You sell immediately, no questions asked.
This really reinforces the whole idea. It's a mechanical, non-emotional exit. The goal is not to fall in love with a stock or its story. The moment the conditions that got you into the trade are gone, the trade is over. You just sell and move on. Getting emotionally attached is really the enemy of a process like this. Now, take a look at this number, 18. In an entire year of trading, the person who developed the strategy only made 18 trades. This single number tells you almost everything you need to know about the next part of this process. Because that number reveals a profound truth about this strategy. It is not about being busy. It's not about constant action. The vast majority of your time is spent doing nothing but processing information and waiting. It is fundamentally a game of patience. You're just waiting for that rare moment when all the pieces, the volume, the catalyst, and the technical entry line up perfectly. And only then do you act. So all of this, the patience, the strict rules, putting all your eggs in one basket, it all brings us to the core philosophy that holds this entire strategy together. It's built on a specific belief about how you actually generate significant wealth in the markets.
And this famous quote from Warren Buffett just says it all, doesn't it? Diversification may preserve wealth, but concentration builds wealth. We all know diversification is a great strategy for protecting what you have. But this approach argues that if you want to really build wealth, you have to have the conviction to concentrate your money into your absolute best ideas. It's a trade-off, really, between playing it safe and having the potential for those outsized returns. And so that's the question we'll leave you with. We've just laid out a methodical process for applying extreme concentration. It's definitely high risk, high reward, and for sure not for everyone. But it does force you to ask a fundamental question. What is the role of a calculated, concentrated bet within a strategy that's truly aimed at building wealth and not just preserving it?